we see this poor confused face here? This is a guy who invested all his money into a savings account and has wondered after 20 years why his money is still worth the same. So let's not turn into this guy. Let's be better than this guy.
What's up, you guys? It's Mrs. Invest. Welcome back to my channel. Today I want to talk about what are some personality traits or characteristics that are more likely to make you successful investing in the stock market compared to unsuccessful. And here I just want to be clear, I'm talking about long-term investing strategies. So not penny stocks, not get-rich-quick schemes, but long-term investment. Now, I'm no investing dinosaur, but I've been invested in the markets for a little over 11 years now. And I've seen different stock market events, for better or for worse, and different reactions that people have to these different stock market events. And there are certain personality traits and characteristics that I've noticed that tend to cause people to be more successful and to cause people to be less successful. Before you even start investing in the stock market, I think the most important thing, the number one thing, besides having money to invest, is to get yourself in the right mindset. The stock market can be really emotional when you're first starting out. You've got money, you have emotional attachment to that money, and it can be quite the roller coaster. So if you don't have your mindset right, the market can really eat you alive and really sour people's experience doing their own investing. Investing in the stock market is really a marathon, it's not a sprint. And as we've seen in the last couple months, it can be a real roller coaster. And you really need to keep your emotions in check and have the right mindset in order to be successful over the long term. And in that roller coaster, there's really good times where you're on top of the world, and there's really bad times, as we've seen in these last couple months. And I think the way you behave during those really bad times really defines you as a long-term investor. So I'm just going to share, in my opinion, certain personality traits and characteristics that you can possess that, in my opinion, will make you a successful long-term investor. Now, you may have these personality traits already, or they may be things that you can sort of hone and work on in order to increase your chances of being more successful. So let's get right into it. So the first characteristic of successful long-term investors is they have a strategy and they stick to it. Now, you may have heard the terms like dividend growth investing. Let's just use that for an example. Dividend growth investors are investors who invest pretty much exclusively in dividend paying stocks, and then they use those dividends to reinvest and to buy more dividend paying stocks, and then that snowball continues over time. Now, if you've ever met a dividend investor in real life, this strategy has a cult-like following. Dividend growth investors are so passionate about their strategy, and they've often used this strategy for 10, 20 years, and they've stuck to it over the long term, and they swear that it is the golden goose of investing, dividend growth investing. But there has been some criticism over this strategy because companies that pay out moderate to large dividends are often a very specific type of company, and dividend growth investors have been criticized for missing out on other types of companies and other stocks like growth stocks or broad market index funds. And they don't care because they're so happy with their dividend growth investing strategy. And so although it's a good strategy, it's a little bit myopic and you're focused too much on one thing, but that doesn't make it a bad strategy. But one reason dividend growth investors are often so successful over the long term, even though they may not be using the best investment strategy, is because they've had a plan and they've stuck to it over the long term. And that is really the key as to what has made them so successful. So one really important factor when you're doing your own investing and you want to be a long-term investor in the stock market is have a plan and stick to it. And I mean, it would be great if you didn't pick the worst possible plan, but just have confidence in the fact that even if you're not doing the best possible investing, if you have a good plan and you stick to it for the long term, you're probably going to do pretty well. And the second characteristic of successful long-term investors is that they're accepting of risk. You cannot make money without taking some level of risk. And if you think about savings accounts or GICs, where there's virtually no risk, there's no chance that you're going to lose the money that you put in. You're maybe making 1% on your money, and if you think about inflation at 2%, That's the amount that your money is losing value every year. By having your money in a savings account or in a GIC, your money is actually losing value over time. And so that's why most people are accepting of stock market risk, because they know that unless they take that risk, there's no reward on the other side. Now, we often hear about how the stock market returns an average annual 7% return. But if you look historically, there's actually very few years where the market has returned around 7%. And what people really mean when they say this is over the long term. So there'll be some years where the stock market does really well. It'll have made 10, 15, 20% that year. But there's also some years where it does really poorly and the market crashes, or there's a negative 10, negative 15%. There's been negative 30% years. And what they mean when they say average annual 7% is when you average out the good and the bad, on average, you're going to do around 7% return. And most successful long-term investors are accepting of that level of risk because they realize they need to accept that risk in order to do well. Now, when we're talking about risk, we're not talking about just blindly throwing your money into different stocks and hoping for the best. There's different types of risk in the stock market, and although you are taking risk, there's ways to reduce that risk despite having your money invested. And so there's something called systematic risk, which is risk of just having your money in the market. You cannot diversify your way out of this risk. You cannot do anything to reduce that risk other than not have your money in the market to begin with. And a really good way to just have systematic risk would be to invest your money in a broad market index fund. And then there is unsystematic risk, which can be diversified away. So let's say you put all your money into Tesla, or into, nothing against Tesla, but let's just pick a random company, where you put all your money into an oil company, or all your money is in a financial sector. That is unsystematic risk. You can reduce your risk by diversification and spreading your money more thinly and spreading it out over more different sectors, different market caps, in order to reduce your risk. So yes, there's risk in the stock market. You're not going to make money ever without risk, but there's ways to reduce that risk, to minimize it to just market risk, as opposed to taking on excess risk through poor investment strategies and lack of diversification. And the third characteristic of successful long-term investors is that they have emotional durability. Now, this is up for debate, but in my opinion, I think this is one of the most important ones, and that is removing emotions from your investments. Money is a very emotional thing. You've worked hard for it, you've paid tax on it, and now you're finally ready to invest it and you don't want to lose it. You do not want to be affected by fear, greed, fear of missing out, running your trading decisions based on how you're feeling. This is a really hard thing to learn, and myself included, and I think most people have made emotional investing decisions and have regretted it later. And one thing, if you're not yet invested in the market and you're having a hard time understanding what this means, is imagine just looking at your portfolio one day and over the course of a month seeing your net worth drop by 30%. A lot of us went through this just this past March. And like I said at the beginning of the video, what you do during these emotionally charged times really defines you as a long-term investor. If you are investing for the right reasons, you're investing in companies that you believe in or in broad market index funds, and you don't need that money in the short term, in my opinion, these 4 ways give you the most insurance to not make poor investment decisions based on emotions. So if you put your money into the market and you need that money in a couple months for your house down payment, but you're hoping to make a quick buck and oops, the market goes down, that is a situation where you're going to put yourself to make a poor decision based on emotions, because you're going to panic, maybe withdraw your money at a loss. But again, if you've got your mindset right, and you have a plan and you're sticking to it, then it's a lot easier to ride out the tough times and not make decisions based on emotions. The majority of the time, if you're making an emotionally charged decision in the stock market, you're probably making a bad decision. And the 4th characteristic of successful long-term investors is that they're okay with losing money. Now let me explain. I'm talking about day-to-day fluctuations, mild corrections, massive market sell-offs. Although you haven't sold your shares, you're still invested in the market, and so your portfolio value is constantly going up and down. And sometimes during massive market sell-offs, it can go down by a lot very quickly, and that can be scary. But when the sky is falling and the crowds are trampling over each other in a mass panicked frenzy selling their shares, the investor who can stay calm and see the big picture will win. Actually, the relaxed, thoughtful people who can see the big picture can recognize the undervalued opportunity in these market sell-offs and capitalize on them. Come here, Cedar. Hi, Cedar. You want to talk about investing? Hi, Cedar. What's your opinion on the stock market? Okay, Cedar has joined us now. She's decided that she wants to be involved in the discussion about the stock market. This is my 7-year-old retired racing greyhound. She raced in Orlando, Florida for 70 races, and she is thoroughly enjoying retirement. So the fifth characteristic of successful long-term investors is that they are consistent. And what this means is you put money in as much as you can, as often as you can, without missing large periods of time. So by nibbling away at the market throughout the year, it reduces your risk that you're going to invest at the worst possible time, meaning the time where the market is peaking and it's right before it's going to crash. And if you're putting a little bit of money here, a little bit of money there, chances are you're going to invest at some really good times when the market is dipping or it's low. Most of the time you're going to invest at an average time, and there's going to be a couple times that you're going to invest where the market is peaking. And that's okay, because in the end they all average out. They help you reduce your risk, and they help you to stay consistent over the long term. And the next trait is that successful long-term investors are able to tune out the noise. In the age of social media, we have people all over on Twitter, on Reddit, on Discord groups talking about what they think is going to happen to a particular stock or to a particular market, or what's going to happen within the next few months. And often there's a lot of people online who are either pumpers or they're betting against a stock, and sometimes these opinions that you hear online can be misguided because the person has an investment on their own terms about whether that stock does really well or does poorly. So you don't want to take someone's random person's opinion online, even me. The advice I'm giving you right now, I'm just a random person online. I'm just sharing my opinion, but I could be wrong. And you don't ever want to buy a stock or invest in a company because you read on Twitter that someone says this stock is going to the moon. You want to do your own research and to feel confident in yourself, regardless of what other people think or say in the companies that you're investing in. And that's really important. Tune out the noise and focus on what your plan is. And the next characteristic is humility. And this means you don't inflate your ego if you buy a stock and it does really well. As soon as you think you've figured out the market, I like to call her Mrs. Market. She can never be figured out. And I found that as soon as you start to get a little bit egotistical, she will always find a way to humble you. So if you think you're the King Kong of trading, you're only as good as your last purchase. And so just keep that in mind. Be humble. If you do well, be grateful, but don't be egotistical about it. And realize that you are really at the mercy of Mrs. Market and whatever she wants to do. And the next characteristic is patience. Now, having a steady hand when it comes to investing in the stock market is really important. And in the world of stock market investing, oftentimes patience equals profit. So just keep that in mind if you're ever panicked or you're worried about what's going to happen tomorrow or next month, or, oh my goodness, the president is changing, what's going to do that going to do to the market? Staying the course over the long term is going to give you the best chance of success regardless of what the day-to-day fluctuations are. So stay patient and you're probably going to do pretty well. And the last characteristic that I can think of is being optimistic. People who are successful in the stock market long term are optimistic that the positive years in the market are going to outweigh the negative years in the market. And they believe, and I believe this strongly, that over the long term, the stock market goes up. You've all seen that meme, stonks only go up. Well, it's not always true, but over the long term, I believe that the market is going to go up. I have a very optimistic opinion about the market, and so that is what allows me to stay invested. When there's a down day, I don't say, oh my goodness, I'm losing all my money, everything's going to zero. I see it as an opportunity to buy companies and stocks of different companies that I have been eyeing at a better price. And so that optimistic attitude, I think not only just in the market, but in life in general, is really important to be successful. So that's it. Those are my ideas of traits and characteristics that you can possess in order to be successful in the market. Let me know if there's any of them that you're struggling with. I think we've all struggled with them at one point or another, but really being able to hone these skills will give you a good chance of becoming more successful as a long-term investor. Please let me know in the comments what other videos that you'd like to see, and I can certainly do them or talk about different topics. And thank you so much for watching, and we will see you in the next one. Bye.